and if you can see me as well. Just a show of hand or just a quick few messages on the chat. That should be the one. Super. Great. Thank you, guys. Thanks, folks. Yeah, responses are good enough, so I can assume that everything is loud and clear. I hope you can see Gautam as well on your screen. We will be starting in a minute or so. Eager to hear Gautam as well. For the folks who can't hear, I think if you can put your earphones, AirPods, plugs, whatever it is, so that it's easier and it will cut out all the background and outside noise as well, because the majority can hear. So thank you once again. Good afternoon, everyone. This is Mayuresh Joshi of William O'Neill. Extremely pleased to welcome Gautam Baid in this new year 2022. He's our first elite speaker and he's gracing our platform and guiding all retail investors and all of us, specifically this time when the markets have become extremely volatile over the last few days. About Gautam, Gautam is a CFA charter holder and a member of the CFA Institute. He's also the founder of Stellar Wealth Partners, a SEBI-registered RA firm, and he's a small case manager for investors in the Indian stock market. Gautam is also the founder creator at Chapter, a curation-based investing platform where he teaches the discipline of investing. He's also authored the international bestseller on value investing, The Joys of Compounding. And in his previous stint, or avatar, he served as a portfolio manager at Summit Global Investment, an SEC-registered investment firm in the US. I'm pretty sure you would have read Gautam's books. You would have heard Gautam on his blogs, on YouTube videos as well. So it's a great pleasure in introducing Gautam Baid. And Gautam, thank you so much for gracing our platform. Welcome to Walk the Talk.
Thank you for the kind introduction, Mayuresh. It is a pleasure to be here.
Super. So I think the first question, Gautam, and let's jump right into it. Last few days, extreme amount of volatility displayed by equity markets. A lot of expectations that are coming in on the Indian context when it comes to the budget. And I think a lot of presumptions being drawn out on what the US Fed will do when it comes to global inflationary conditions and liquidity conditions being withdrawn as well. So I think your quick take or a quite your synopsis in terms of where we are at this point of time, global perspective and Indian markets as well.
So it's very clear that the Federal Reserve of the USA is in panic mode. Earlier, they were too slow to start winding down their QE program. Now they are in a hurry to wind it up as soon as possible and start the interest rate hike cycle. And as all market participants know, interest rates act as gravity on valuations. So equity and interest rates generally have an inverse correlation. And when interest rates go up in a environment of slow growth, then equity valuations derate. The only environment in which interest rates go up gradually and equities go up in tandem is when you have strong economic growth. So for example, between 2003 to 2007, even though the global central banks were increasing interest rates, because the underlying economic growth of the emerging markets and the globe was very strong, that's why you got the big rally. So as long as growth comes, we should be fine. But irrespective of that, I think in an environment of rising interest rates, the loss-making companies, the companies with very, very high P multiples, they are the ones which should face sustained derating over the next 1 to 2 years, because they were basically bidden up. They were getting bid up in an environment of easy liquidity and low interest rates. But they are the first to collapse once the interest rate cycle starts reversing and the liquidity conditions tighten. And that's what we're seeing in the US as well. If you have seen stocks like Peloton, Zoom, Teladoc, all the other fancy work from home stocks, which had no earnings basically, which were enjoying a temporary tailwind to their earnings from COVID. Now all of them are down 70 to 80% in the last 1 year. That is the kind of brutal sell-off which takes place when the temporary tailwinds just go out. So it's very important for investors to stick to the valuation discipline and not end up paying any price for any company, because over time the stock market keeps teaching us this important lesson that there is a big difference between a great business and a great stock. So always be mindful of valuations. The only time you can afford to pay a high multiple for a stock is when you have got high longevity of growth and very high rate of earnings growth. That is the time when you can actually live with high valuations. But at other times, you should always be mindful of the price of your entry.
Oh, absolutely. Point taken, Gautam. Which brings me just to a follow-up questions on the same. So you've seen Nasdaq as an example in the US market move significantly higher, and the correction has been equally brutal so far. So do you see a major component of Nasdaq which is dominated by tech stocks, growth-oriented stock, as you said, and where valuations, in your opinion, and obviously in terms of their historical prevalences as well, had gone up significantly? So do you see significant correction yet to happen there and a rub-off effect, therefore, on Indian equities, considering what is happening across the globe as well?
So whenever we speak about correction in any indices, we should carefully look at the composition of the indices. So here, compared to year 2000 when the tech bubble burst, today the Nasdaq composition, if you look at it carefully, it's primarily dominated by very highly profitable cash generating companies like Google, Facebook, Microsoft, Amazon, and it's that is why the index may not correct that much, but the underlying constituents of the Nasdaq, more than 90% of the stocks in the Nasdaq are having obscene valuations even after the brutal correction of the last 1 year. They may get further derated, and that is where the pressure may be felt. But as what happens in every bear market is that the market differentiates between the long-term secular growth companies and the companies which were just temporarily bid up in an easy liquidity condition. That is exactly what we're seeing in the US right now. The Nasdaq is barely 10-11% of its most recent peak, but many stocks within the Nasdaq are down 70 to 80%. And that is why over the long term, it's all about bottom-up stock picking and focusing on the microeconomics of each individual business. That is ultimately what long-term investing is all about. These short-term fads and fancies of the market, they are for traders, but we are long-term investors and we focus on long-term secular growth trends. That is where the really big money is made, because you want the power of compounding, you want the power of time to work in your favor. That can only and only happen when you have a long-term mindset and when you remain invested inside the stock market with a portfolio of good companies. I'm not advocating for you to just stick to one company, one stock for the long term. All that I advise people is to remain invested inside the stock market for the long term in a portfolio of good companies, because situations and facts change. There's recently a chemical company in India. It was highly touted as the next big thing, but it got mired in corporate governance issues because of some lack of environmental compliance, and the stock just got hammered over the last 2 weeks. So when facts change for the worse, just change your mind and move on. There is no dearth of opportunities in the market.
Oh, absolutely. And when you define Gotham long term, I think what is the time horizon that you're looking at, specifically when you're talking about sectors which have these secular tailwinds with them? And do you review, I mean, even within the long term portfolio and your compounders, how often should you be reviewing the stack within the group that you, or generally, I think these compounders that anybody owns?
At Stellar Partners, we advise all our clients to have a long-term mindset and invest with us only if they have a minimum time horizon of at least 10 years and more.
Okay.
There's a reason behind it. So the power of compounding is backloaded. So just to give you an example, if you compound your capital at 20% for 25 years, your initial capital becomes almost 100 times, which means if you invested 10 lakh rupees today, it would become almost 10 crores at the end of year 25. But you should note that out of that 100 times, almost two-thirds of that, or 62 times out of the 100 times, comes in the last 5 years. At the end of year 10, you would have 6 times your money. At the end of year 20, you would have 38 times your money. So 62 out of the 100 came in the last 5 years. So compounding will bestow its magic and benefits upon you only after testing your patience and conviction to the fullest. And the stock market is designed in such a way so as to basically exploit our biggest weaknesses of greed and fear.
Sure.
To test our tolerance for pain through downside volatility, which keeps happening now and then every year. Years like 2014, 2017, 2000, large parts of 2021. I mean, those are years with very low volatility. That is not the norm. The stock market is designed to be volatile because it is made up of human beings, and human beings, are basically are just filled with so many behavioral biases that the stock market is destined to be volatile, on a regular basis. So that's a feature. That's not a bug. But that is how you get the big long-term gains, just by staying put in spite of all the ups and downs and just ignoring the noise.
Oh, absolutely, Gautam. So I think a difficult question now that I want to ask you, that you put us in this context of macros and how global markets are positioned. Are we still in a structural bull market? And if we are, do these corrections happen? They have happened historically as well. And do we really need to get scared or fearful of that? Or is that an opportunity for investors to get in quality structural compounding stocks?
Most investors in India have been basically panicking on every fall ever since Sensex was at 100. We started with 100. Then when we went to 1,000, that time people said the stock market is overvalued. Then we went to 10,000. That time also people were saying it's overvalued. Then we went to 20,000, 30,000, 40,000, 50,000, 60,000. We'll eventually cross 100, 1,000 also. And then eventually we'll probably one day go to more than a 2 lakh also. But the idea is just to remain invested for the long term. That is what is really the most important. Just remain, just be steadfast and just stick to your discipline, and don't worry about this all the short term corrections. In the last 15 years I've seen so many corrections and crashes that
Yeah.
now these things have just become a routine feature. Nothing to get worried about. Just focus on the underlying business of the stocks that you invest in.
Oh, absolutely. Now let's take an example that you probably mentioned in your book as well. So the examples that you use, the analytical principles, tools, and processes that you highlighted in your books. For folks that who've not read the book, I think please go through his book, The Joys of Compounding. It's a pleasure to read. And Gautam has mentioned very categorically one of the chapters, the analytical principles, tools, and processes that he uses. So how do you use this and how do you apply them to make a successful investment? If you can just educate our retail investors as well.
Sure. So traditionally, there have been three sources of advantage for the individual investor: the information edge. But with the advent of the internet and widespread dissemination of information, the information edge is gone. The second source of edge traditionally has been the analytical edge. But with more and more smart people entering the investing profession, even the analytical edge is fast getting compressed. But the one edge, which is the most sustainable and durable in my view, is that of behavior and temperament. And I've talked about the same in
Yes.
very great detail in my book's chapter on delayed gratification. And implementing the principles from that particular chapter have helped me achieve some of my biggest multi-baggers till date. And let me illustrate with the help of a personal example.
Absolutely.
During 2018 and 19, after the NBFC crisis, the Indian auto industry entered a downturn, and there was an auto ancillary company named Rajratan Global Wire, which was undergoing a big capacity expansion. Because the entire auto sector was out of favor, the investors' attention on this particular stock was low. But as soon as the capacity expansion got over in early 2020 and the earnings visibility went up post a recovery in the auto cycle, the stock of Rajasthan Global has given more than 1100% returns since April 2020. This is why Harvard Marx has said rule number one, most things will prove to be cyclical. And rule number two, some of the greatest opportunities for gain and loss come when people forget rule number one. And this is deep value investing at its finest. You want to buy these big capex plays when the industry is undergoing a down cycle, because you get to buy them at low valuation and low market caps. And the key is to focus on the balance sheet, whether the company can survive another 2 to 3 years of a downturn. Then you buy them at cheap prices, then you hold on to them patiently till the cycle turns. But this approach, this contrarian approach to investing, requires a lot of patience and a long-term orientation. So this is why patience is a superpower in the stock market. And you can, if you have some of these deep value stocks in your portfolio and just patiently hold on to them, over time they'll significantly contribute to the returns at a portfolio level because they end up becoming big multi-baggers.
Oh, absolutely, Gautam. Now within the industry grouping itself, right, there might be a lot of competitors to the example that you've given. Now, how did you shortlist that this particular XYZ company might do better than the others over the same time period or over a longer term time period, considering that the dynamics of the industry probably remain the same? So I think is there any tool in terms of identification of how one company might be better compared to the other in that same stack?
The answer is very simple. The biggest friction to value creation is competition. And there's a saying, like Charlie Munger very nicely said, riches lie in niches. So you want to focus on niche companies having durable competitive advantage, having dominant market share, and offering a critical input, which is a small percentage of their buyer's overall cost. So in case of Rajasthan Global, bead wire is basically a very tiny component of all tire manufacturers' overall cost of production. So even if Rajasthan Global hikes its product prices by a significant percentage, for the tire manufacturer, the end customer of Rajratan Global, it won't really make much of a difference. So these kind of companies like Rajratan enjoy pricing power. And that is the key to long-term wealth creation. You want to buy companies which have got pricing power. And pricing power can only come when you have got little or no competition. You are enjoying market dominance. So this is one of the finer nuances of identifying such companies. You basically want to minimize competitions. For example, right now we are seeing a electric vehicle boom in India.
Yes.
The OEMs will basically end up fighting with each other for market share, and they'll keep. But the big money will be made by investing in auto ancillary companies, which are the sole supplier for any critical component to these OEMs, because that is where competition will be less, and that is how you'll make the big money. You want to basically find spots where competition is less and earnings growth is very high, because that is how you get sustainability.
Absolutely. In fact, I was going to come to the same question on the EV disruptions that have got created. And that is the big theme, right? As you rightfully mentioned, over the next few years. So I think, is it the auto ang space itself, Gautam, or do you think even the OEMs ultimately should benefit from this longer term trend going forward? Or the auto ancillaries will make the first
Is
move?
that for many of the OEMs, they'll end up this when they roll out their EV basket, it'll end up cannibalizing the existing ICE sales. So that is the big issue of it, investing in OEMs. So that's why I prefer to play this electric vehicle theme through an auto ancillary, or preferably. That is what my personal preference would be. I'm basically looking for places where competition is minimized, and it's very clear to me that there is many of these private electric vehicle companies funded by all these venture capitalists and private equity players may engage in irrational competitive
Sure,
tactics.
sure.
So that's why I'm a bit wary of playing it through OEMs. I can play it through an IT company. So in our Megatrend small case, we are playing it through a digital transformation company, which is catering exclusively to the auto sector.
Absolutely.
That already some very good gains have been made there. So I think if you want to engage, if you want to play the hyper growth of any industry, you can play it indirectly through an ancillary industry which has low competition. So I'll give you another good example here.
Sure.
So over the last 2 decades, the Indian aviation industry has had very good growth, very, very high growth, but the value creation has basically been nil because of intense competition among the airlines, right? So if you want to participate in the hyper growth of the aviation industry, you can participate in it indirectly by picking up some some listed luggage company, for example, where
Sure.
because the competitive intensity in the organized luggage industry is less compared to the high intensity in the aviation players industry.
Oh, absolutely. So I think, folks, what Gautam is trying to say is that the disruptions that are created, I think the leaders who will probably rule the disruption, it's not necessary that the end industry probably gets the lion's share upfront. I think the disruptive industries like auto ancillary is an example, aviation, what Gautam mentioned. So I think they were quite insightful snippets, Gautam, on those points that you mentioned. Now, let us come back to your investment philosophy and value investing in general. I think so. Value and growth. At William O'Neill, we are typically growth investors, Gautam. But typically, in your case, I think value investing, in your opinion, has endured for 100 years. What makes it evergreen? I think what are the conditions that make value investing proposition evergreen kind of thesis going forward?
The principle of buying something for less than what it is worth will never get old. And Phil Fisher had rightly said that the stock market is filled with people who know the price of everything, the value of nothing. Stock prices are known to everyone in the market, but value is understood by only a select few. Stock prices randomly fluctuate every single day, sometimes wildly on either side, but the underlying business value changes very slowly. And therein lies the big opportunity for us as value investors. Focusing on what is moving is part of our evolutionary instincts, and that explains why market participants keep focusing on the volatile stock prices, which keep bobbing up and down every day, rather than on business values, which change very slowly. Capitalizing on others' desire to avoid volatility is what makes value investing work. And Joel Greenblatt very aptly put it, value investing works, but value investing does not work all of the time. And that is why value investing works.
Absolutely, point taken. So I think coming to another acronym which is used in the market, Gautam, growth at a reasonable price. So I think if you can educate investors that your definition of growth. I think what is your definition of growth? Whether the companies need to grow at a certain pace, their margin profile, their capital allocation and return ratios, reinvesting in the business. That's one part. And reasonable price. I think is it historically based in terms of the valuation check that you do? Or if earnings are happening at a compounded pace, valuations probably can just take a little bit of a rest when earnings are getting delivered at a very strong pace.
The biggest money in investing is made basically through what I call variant perception. So variant perception refers to situations where you have got earnings growth coupled with ROC expansion or return on capital employed expansion. You get valuation re-rating and you end up getting multi-baggers. So rather than growth investing or value investing, I'm looking for growth in value. But what that means is I'm ready to pay $1 for $1 of value today, as long as that $1 can grow to two, three, or four, or even $5 over time. The idea is to look for growth in intrinsic value, and growth in intrinsic value simply happens through a very simple way. So you want to look for return on incremental capital invested, and you simply multiply that by the reinvestment rate. So that is basically how you get the intrinsic value compounding power of any business. That is how you get the compounding machines. Basically, you want to look for businesses which can get a lot of free cash flows from their core operations, and then reinvest those cash flows back into the core business at high rates of returns.
Yeah.
So there are many legacy businesses in India like Colgate and other MNCs like Gillette. They basically have very high returns on capital employed, but they don't have any internal reinvestment opportunities. So they end up becoming dividend plays. So they are good for preserving wealth, but not for growing wealth. And they are basically preferred more by the HNIs and the people who are already having very large portfolio sizes. So they tend to prefer these MNC stocks for wealth preservation and just keeping up with inflation over time. But if you want to grow your wealth, you want to basically look for companies with compounding power, or which can basically keep redeploying a lot of cash flows back into the business and growing for a long period of time. The stock market always places a very high emphasis on longevity of growth and predictability of growth over short-term transitory factors. So a company which is expected to grow earnings at 50% or 200% for the next 2 to 3 years with no clarity thereafter is given a lower valuation multiple than another company which is expected to grow earnings at 15 to 20% for the next 10 years and more. So this phenomena perplexes many newcomers in the stock market, but with time and experience, they come to appreciate the market wisdom that the markets are a compounding machine, and they tend to basically discount the very long-term earnings of a business. And good investing,
Yeah.
is all about terminal value. In fact, Utpal Seth had very rightly said that all investing is it's all about terminal value. So you don't have to have a precise DCF calculation on an Excel spreadsheet. What you need to have to be successful in investing is to have a DCF mindset. You want to understand the drivers of terminal value, because that is really all that drives P re-rating and P de-rating. And what drives the terminal value? It is primarily the discount rate.
Yeah.
The discount rate, which you use for valuing any business, is driven by only one single thing: the risk perception among investors regarding the cash flows of the business. It's all about risk, is all about volatility of cash flows. So as the risk perception among investors go down regarding any company's cash flow, the discount rate which they use to value the company, that discount rate goes down and the valuation multiple goes up. I'll give you a good example here. So recently Saregama Limited did a QIP of 70 crore rupees. And even though the stock had already got a lot of re-rating before that, the moment the management mentioned that that entire money from the QIP will be deployed in the lucrative music licensing business, the stock got further re-rated, because there was always a risk that they could have deployed that money, QIP money, in the loss-making Carva and film production business. But the moment the risk perception among investors regarding this business went down after this clarification from the management, their discount rate went down and the valuation multiple went up further. So this is really how the entire valuation re-rating, de-rating game plays out over the long term. And this is how you can basically generate the big alpha in the market, because valuation re-rating is a big part of alpha generation.
Oh, absolutely, and wonderfully explained, Gautam. I think the investors and folks were hearing, I think that was wonderfully explained by Gautam. So, Gautam, I think which sectors, without naming any stocks, do you feel where the logic and the philosophy that you recently or right now explained will work over the next few years? So, I think which pockets of the market do you think such examples might turn into successes?
So at Stellar Wealth Partners, we focus on long-term structural trends. I mentioned about variant perceptions a bit earlier, but we also focus on long-term structural trends And long-term structural trends are found in industries with a very favorable structure. They tend to be structured as a monopoly or a duopoly or an oligopoly at best. They are experiencing some form of an industry tailwind. They have consistency and predictability of cash flows. And they also are characterized by value migration. In India, we have had value migration for a long time, from unorganized to organized, from public to private. And there are multiple structural growth plays in India at the moment. You have got contract development and manufacturing organizations, or CDMOs. You have got contract research and manufacturing services, or CRAMS. And you also have specialty chemicals having critical application. They are in a long-term structural uptrend. You have fintech, music streaming, e-commerce, digital transformation, cloud computing. There are, and also within autos, you have got electric vehicles, which I talked about. So you have got multiple long-term structural growth trends playing out. And what you will notice in these cases is that the entry valuation may be very high. So you may not end up making returns for the first year. But if you have the benefit of having a long-term mindset is that the loss of return in the first year will be more than made up from the second year onwards. So basically the compounding engine will take over from the second year onwards. In the meantime, in the first year, if your portfolio has also got some deep value plays and special situations and other variant perception plays, they'll contribute to the returns in the portfolio in the first year. So a portfolio well made is one which is composed of multiple mega trends which provide long-term compounding, as well as shorter-term tactical opportunities like deep value, cyclicals, commodities, and special situations like demergers, reverse mergers, and other similar situations.
Oh, absolutely, I think so. That's a wide basket that Gotham has given folks. So I think you can individually now look at leaders within those spaces which are having monopolies, pricing power, and who do not have sufficient competition with them. So I think that's a good enough list that Gotham has shared with us. Within the list, Gotham, I just wanted to explore a little bit more in terms of fintech, because that's also one huge buzzword over the last few quarters, and might just be the buzzword of the next few quarters, along with EV and renewables as a space. So how are you looking at these fintech companies, the recently listed ones, or the companies who are trying to make a transition into this space itself? Do you think that this space will compound over the next few years structurally?
Well, I think within fintech, one of the categories is buy now, pay later. But as we have seen globally, a lot of these BNPL companies have
Yeah,
just blown up. So lending is very easy. I mean, people are ready to take money from you. But in lending businesses, what really matters is your ability to recover back the money, collection efficiency. That is what really matters. And that is where I think where a company like Bajaj Finance, which is now pivoting into the fintech space, basically has a big advantage because they'll be lending directly from their balance sheet, and that is where I think the really big value creation can happen. I'm not really bullish on many of these private fintech companies, and because they just lack the lending discipline, and I think they are just chasing growth to get, because many of these private companies, when they get funding, they are primarily valued on growth metrics. But for long-term sustainability in any lending business, you want to look for companies which have got good collection efficiency and very good underwriting skills. I think that is the most important.
oh, absolutely. Point taken. Now let's jump back a little bit in terms of your own investment journey. I think your own investment journey, Gautam, has evolved over the years. So you would have started with some set of ideas at the beginning, and then you slowly inculcated your learnings into the market as you started new things. So if you just want to explain briefly to our investors your entire investing journey.
Sure. So my investment philosophy and investment opportunity set has significantly expanded over the years with time and experience in the markets. Initially, I started with investing in low price to earnings and low price to book stocks because, as is typical of most investors, I started off by reading Benjamin Graham's The Intelligent Investor. Later, I read about Warren Buffett, Phil Fisher, Charlie Munger, and I started investing in high quality businesses at fair to reasonable valuations. But today, it covers multiple areas of the investment universe, including deep value, cyclicals, commodities, turnarounds, and special situations like demergers and reverse mergers. And instead of being restricted by my narrow, biased views to a small opportunity set, as was the case in my early years, now I'm able to invest in a variety of industries and situations wherever I find mispricing of value and a highly favorable risk and return trade off. You see, no single strategy works all of the time and in every kind of market. And that is why it is essential to build up one's investing arsenal to be able to hunt for value from within different areas. And over the years, I've come to realize and appreciate just why this is so critically important.
Yeah,
It is because a bull market is always going on at all points of time in some specific sectors of the Indian stock market. So, for
absolutely.
instance, during the 2009 to 2013 bear market in India, IT services, FMCG, and pharmaceuticals created a lot of wealth for investors. And all investors should understand that new trends always emerge during a bear market. And
Absolutely.
you should, during the fag end of a bear market, you should be alert to which stocks and sectors are breaking out to all-time highs, because that is where the next set of winners will actually come from. So the market itself will tell you where the next bull run is going to take place, and which sectors are going to lead the next bull run. You just have to pay heed. You just have to pay heed to the market wisdom and pay attention to what the market is trying to tell you instead of trying to fight with it. I think that's also a very humbling realization most investors get over time, that the market is basically providing you collective wisdom of millions and millions of participants. So make use of that collective wisdom.
Absolutely, Gautam. In fact, our founder William O'Neill emphasized on the same philosophy. If you would have read his book, The Art of Making Money in Stocks, so I think the same logic that you put forth, that new winners will emerge into a bull in a bear market, into the next bull market, and new leaders within those spaces will emerge as well. So absolutely, I think point taken on that. In terms and in continuance of what you just said. So, is there a checklist that you've got in terms of your high quality investment decision making as well? Some check boxes that you actually tick when you actually make those decisions at play.
Yes. So a prudent investor never purchases ownership in a business without conducting the necessary due diligence. So you should always study about the company and its competitors, both listed and unlisted, by reviewing the company's website, company filings, information on the internet. After that, you should read the last 10 years of annual reports, proxies, notes and schedules to the financial statements, the management discussion and analysis section, or what we call MDA. Within MDA, check for changes in management tone and industry outlook, and also observe the recent trends in insider shareholding. After you've concluded this initial groundwork, proceed to study the following parameters in checklist fashion: income statement analysis, balance sheet analysis, cash flow analysis, operating efficiency analysis, returns ratios analysis, management quality analysis, and
Okay.
a psychological checklist of the standard causes of human misjudgment. And all the seven categories are detailed in my book's chapter on checklists. One should, and at the same time, investors should understand that the ideal checklist is subjective and it varies from situation to situation. For example, the primary checklist items you look at when evaluating deep value, cyclicals, or commodities, or a special situation is very different from the primary checklist items which you look at when you're analyzing high quality secular growth companies, where quality of business and quality of management is the most important.
Oh, absolutely. Point taken, Gautam. Now it gets me to this question in terms of your style itself, and then you have written in your book, the frequency of correctness does not matter. It is the magnitude of correctness that matters. Can you elaborate what exactly meant by that in your book?
Yes, so anyone can identify a winning stock, Mayuresh, but the great
Exactly.
investors differentiate themselves through superior individual position sizing. And when you find a truly great idea, you should buy enough of it to make a meaningful difference to your life. Success in investing is not just about being right per se, far from it. Success in investing boils down to how the great ideas are executed, or what we call the art of execution, namely the initial allocation and the subsequent pyramiding. And the frequency of correctness does not matter. It is the magnitude multiplied by the frequency that matters. So basically, you want to look at the frequency times the magnitude of the payoff.
Sure.
And this is what George Soros was referring to when he said that it's not whether you're right or wrong that's important. What matters is how much money you make when you're right and how much money you lose when you're wrong.
Absolutely. So when it comes to individual position sizing, the initial allocation and the pyramiding, the subsequent pyramiding that you talked about, Gautam, how does one get to learn that over time in investing? What has been your experience with that? And have you evolved your processes surrounding the same as well? If you can just guide our investors.
So I size individual allocations in my portfolio according to my evaluation of potential risk, with the highest allocations having the lowest likelihood of permanent loss of capital coupled with above average return potential. I initiate new positions with a minimum weighting of 3 to 5% and subsequently average upwards if the management executes above my expectations. And it's very important to realize that individual position sizing is important not only for its impact on overall portfolio performance, but also for one's mental peace of mind. I sell down to my sleeping point if any single position becomes a discomfortingly large percentage of my portfolio value. One should have higher allocations in businesses with disciplined capital allocators, solid growth prospects, and longevity of growth. As May West very aptly put it, too much of a good thing can be wonderful.
Absolutely. So I think that those aspects are related in terms of your investment philosophy. But what about risk management tools, Gautam? There will be special situations that we saw in March 2020, sudden fall in the market, where everything was looking dizzy and fog all around. So do you practice risk management practices as well, and any tools or mechanisms for risk management on when to exit a particular investment that you from?
Yes, sure. So basically, I'll give you a good example here. So when you're engaging in, let me explain with the help of with help of demergers. So in case of many demergers, you'll notice that initially you'll get what is forced selling. So last year in late March 2021, a stock named Jubilant Ingravia, which had been demerged from Jubilant Life Sciences, it was initially facing a lot of selling pressure, forced selling pressure, because a lot of pharmaceutical funds which were holding Jubilant Life Sciences, they could not, by their very mandate, they were not allowed to hold on to a chemical stock. So you saw the stock of Jubilant Ingravia falling 40-50% post demerger. And then once the forced selling was out of the system, the stock basically ended up rising almost 200% in the next 6 months. But because it's a cyclical business, you have to practice risk management. So you want to, the faster the rise in a short span of time, the shorter the moving average, which you want to use to exit the position in a timely manner. So in case of these companies, depending on your individual risk tolerance, you can either use a 50-day moving average or you can do a 21-day moving average. And once basically the stock starts correcting down to these moving average levels, you basically sell out and you take your profits home. So that's one way of practicing risk management through use of moving averages. Now this applies primarily to cyclical businesses arising from a demerger. In case of long-term secular growth companies, basically many investors also tend to use a 200-day moving average. It's common saying among many in the investing community that if any stock breaks the 200-day EMA, then basically it's all over. Then you just sell out and then you reevaluate and then re-enter at a later stage. So that's another moving average which you can use. Another very good way to practice risk management is through prudent diversification. So at Stellar Wealth Partners, in both our small cases, both the flexi cap and the mega trend small cases are benchmark agnostic portfolios of 25 to 30 names each. And the rationale for having 25 to 30 names is that this is the optimal number of holdings to maximize the risk return trade off. At 25 to 30 names, as per a study published in the international bestseller, A Random Walk Down Wall Street, at 25 to 30 names, you have basically captured all of the benefits of diversification, yet the number of companies you need to know thoroughly is still manageable. So one of the best ways of risk management is to have thorough knowledge of the underlying business of your companies, because that is what will help you stay the course with them for the long term. That's another way of risk management: diversification and thorough underlying knowledge of your company. So I've mentioned three: use of moving averages, having very thorough knowledge of the underlying businesses, and third is diversification.
Absolutely, point taken. So, guys, I think risk management is equally important as Gautam is saying, right? And the three key metrics that Gautam probably tracks is something that you should keep on your monitoring radar as well. Now, Gautam, when it comes to stock selection, I think this is a question that always keeps on running in my mind. You talked about 10 years of balance sheet, transcripts, so on and so forth. Before you finally zoom on through the funnel, the stock that you probably like. How much time, and I think the retail investors will find this interesting as well. So how much time do you actually spend studying a sector, studying the competition, and zooming onto a particular stock? Is there any time limit that you set yourself, or it is random? I think the moment you see it, it might take some time.
So I don't set any formal hard limits on the time spent, but it all depends. So if it's an industry or a sector in which I've invested before, then it will take me much less time. It may take me 2 or 3 days to study current sectoral trends and the company in question. But if it's an entirely new industry, it may take me a week or more to actually get up to speed. But the process is broadly the same. You want to look for well-managed companies with good capital allocation, available at a good price, and enjoying some form of a tailwind. So the process is pretty much similar, but the underlying philosophy is pretty similar. But like I wrote in my book's chapter on simplicity, there are really two or three key variables that really matter to each investment decision. So for any business, there are really two or three variables which make all the difference, and 80% of your investing outcomes will be driven by 20% of your investing insights. So basically, just focus on on having high impact, high quality insights. That's really what will drive most of your investing outcomes. So just focus on the two or three most important variables that really matter to each business and each investment situation.
Absolutely. And the checklist that you've given, I think that probably also helps, Gautam. Now, when you said about your compounders and riding your winners as well, now at some stage you would have also found, if you can give an example on this as well, Gautam, that they have run significantly over the last few quarters, last few months. And as you mentioned, they're far above their moving averages. I think either the growth has got incorporated in the price, or B, I think the risk at that level becomes too high. So when do you probably decide on all your winners that you should probably be curtailing positions, either if your sizes are not too large, either if the stocks have moved too much in price, is that the sole reason? B, is there more juice left in the story that you have studied internally vis-a-vis the competition? Or C, I think if you can trail your stop losses or take some money off the table and probably re-enter again. So I think how do you play this entirely?
So basically, in the Indian market, what I've realized over the last 15 years is that many high quality secular growth companies enjoy a scarcity premium. And that's why I rarely sell on valuation alone. I'm more concerned about the deceleration or the degrowth in the speed of earnings growth. So I'm more concerned with whether the earnings growth is tapering off and slowing down. But if the earnings growth is expected to be very high, then I stay put. But how about, and at the same time, it's very important to be cognizant of the interest rate cycle, because over the last decade, what we have seen is in an era of lowering interest rates, a lot of these slow growth consumer companies in India have basically got re-rated from 30, 40p multiple to 80, 90, 100p multiples.
Yeah.
Will be the first to deflate when the interest rate cycle starts going up, because that's what history basically teaches us. In an era of rising interest rates, the slow growth high P stocks are the ones to first derate. So this is when now is the time when valuation discipline will really shine, and people who have paid heed to valuations will basically outperform from here on. So uh, I don't really sell just because of valuation, as long as the growth rate remains very, very high. And in my book, I've shared many examples. I've shared examples of Adobe, Berkshire Hathaway, Fairfax Financials. There were many stocks which basically gave nil returns for many years. But as long as you have a diversified portfolio of high quality companies, deep value, special situations, basically you want in your portfolio many companies to keep firing many companies to keep firing at any point of time, while the others basically take a rest. So last year we saw many API companies and many of the CDMO companies getting re-rated, and they gave very good returns last year, or the last 1.5 2 years. But now they're taking a rest. As long as the long-term outlook remains good, you just stay invested and you let the other stocks in your portfolio take the lead now. So that is the benefit of having a very wide diversified approach, because then you can participate. Like I said, there is always a bull market going on at all points of time in the stock market. So you want to have exposure to those areas in your portfolio at all points of time. You'll see this for many of the big long-term winners. There were many years in between when they basically went nowhere. So if you just look at the long-term stock price chart of Titan, I believe there was a period of many years in between when the stock basically gave zero returns. But did Rakesh Jhunjhunwala sell even a single share of his Titan holding just because the price was not moving? No, he stayed put in it, and he kept engaging in his other trading activities and other investment activities, and he just stayed patient. When you have found the goose that lays the golden eggs, don't kill the goose, because these high quality companies always end up surprising you on the upside, because they are able to pivot into new adjacent areas and adjacencies and create new sources of value for you. And so a very good example here is that of Astral Polytechnique. So earlier they were primarily in the piping business. Yeah. They ventured into adhesives. Now they're venturing into other areas. So the P multiple of Astral, basically, when it was, I think during 2014-15, it was a 60 times P. Yeah. It was further re-rated to 100 times P. Why? Because the market is now giving additional value to the company, for that additional value being created by entering into new adjacent areas. So these high quality managements tend to find new avenues for growth, and they tend to keep surprising on the upside. So I think it's very good if you have a long term mindset and stay put in these companies and let the other stocks in your portfolio outperform in select years while these companies take rest.
Oh, absolutely, point taken, Gautam. So I think companies where earnings growth is continuing at a good pace, I think no two ways of getting out of that. But since you spoke about the interest rate cycle, your perception that the global markets are facing is that March, and since you invest and track US markets closely as well, that the Fed will have a significant rate hike in March. Also, in the Indian context, I think there are murmurs going around that the RBI or the central bank here might start hiking the rate cycle. So, twofold question here. Rate hikes, as you said, key monitorable. In that context, do you look at the private sector financials in a very favorable way? They've underperformed last year. Can they be major outperformers this year? And what happens to the other end of the spectrum? If the rate hikes start going higher, the consumers of these industries, SMEs, MSMEs, do they get a hit on additional or increased borrowing costs? So how do you weigh these balances?
So let me answer the second part first. These smaller companies will definitely face the brunt of this interest rate hike cycle, as is always the case during every cycle. The smaller companies tend to face the bigger problems, and the big tend to get bigger and stronger. But at the same time, what history also teaches us that these private sector lenders, they also end up getting pricing power in a environment of rising interest rates, because they tend to experience NIM expansion or net interest margin expansion. And recently, Kumar Mangalam Birla talked about a capex Mahotsav in India for the next 10 years. Now, any country to have a sustainable long-term bull market, you want to have basically that is traditionally driven by a capex upcycle plus a real estate upcycle. And India is right now enjoying the benefits of both a residential real estate recovery and upcycle, as well as the capex upcycle. Just look at the quantum of capex being announced by companies across industries. I mean, there are micro caps with 100, 200 crore market caps. They are announcing capex of 200, 300 crores. That is the amount of capex being driven by the PLI scheme of India, of the government of India. You're having a massive capex upcycle. And in any capex upcycle time period, the lenders or the financials, the lending institutions, the well-managed banks, they tend to do very, very well. So you want to definitely have some exposure to the private sector lenders during this to play the capex upcycle. So I'm very positive on the private sector financials and the lenders in particular, because I think the most of the provisioning is done, the worst is behind them. Now they'll start enjoying the growth phase, and the re-rating may happen, because right today no one is looking at them, because many people have been scarred by what happened in 2020 after COVID-19.
Yeah.
And a lot of stress faced by these banks and private sector lenders. But I think the worst is behind now. And whenever any business basically transitions from a low return on capital employed or low ROE, low return on equity, to a higher ROE or higher ROC, you get valuation re-rating. So this is what industry cycle shift or variant perception can help you achieve in the stock market. It will help you achieve the outsized returns. And I think auto ancillaries, banks, capital goods, these are the pockets where I think you may get very good alpha generation over the next 4 to 5 years.
Point taken, Gautam. Absolutely. The other end of the spectrum, public sector banks?
Well, then I tend to avoid public sector undertakings, because the promoter's key motivation there is not wealth creation for the minority shareholders. It's to engage in social good. So while I appreciate the social causes they engage in, I think as a minority shareholder in the public markets, I would tend to stick to the private names. Companies like investors need to understand that companies like IRCTC are more the exception than the norm, and even there the pricing the pricing of the services by that company IRCTC may change anytime, driven by the whims and fancies of the government. So why take then if you're investing in companies like that, then basically you're speculating on what the government of India may do next. So I would just like to keep things simple and stick to simpler and easier things in the stock market, because in the stock market, degree of difficulty does not count. I mean, it's very, because the stock market is filled with people with very high very, very strong academic credentials and having very high intellectual quotients. They just tend to think that the more complex an investment idea, the better they feel about it. So but in the long run, the simpler the investment thesis, the higher the returns. And this has been proven time and again on the long term in the stock market. Simple is better.
Oh, absolutely, point taken. Just a point on IRCTC, Gautam. I think I tried doing a booking and I had to cancel it because of the third wave. But I surprisingly found that it was a very seamless experience, both for booking and refunds as well. But let's come back to your book and a couple of aspects that I want to discuss from your book itself. So in your book, you've also spoken a lot about psychological biases. This also becomes a very, very important perspective that a lot of investors should probably be gauging. But again, these biases prevent investors from making rational decisions. So, could you cite some examples, since you've written that in your book, on how to avoid this, how to fall prey to this bias, and how has this particularly helped you in your decision making?
So in my book, I've talked about my one of my past investments in
Yeah.
a company named HEG Limited in 2017, on which I'd made a big profit on a big allocation. And I exited the stock on 1st February 2018. And just 1 month after the date of my sale, I came across a news report in the media that graphite electrodes, which is the main product of HEG, was selling at an even higher price per metric ton in the market, and that the supply situation was becoming even more tighter. When the facts change, Mayuresh, change your mind. I immediately re-entered HEG, this time with half the percentage allocation I had at the time of my previous exit. And in one single go, I was able to overcome a host of personal biases that had affected me since the beginning of my investing career, namely commitment and consistency bias, anchoring bias, and status quo bias. And let me just quickly elaborate these three biases for the benefit of all your viewers.
Yes.
Commitment and consistency bias basically means sticking on to your previously publicly stated position, even though the facts have changed for the worse. And the easy way to avoid commitment and consistency bias is to avoid talking about your stocks on social media and publicly in general, and to avoid touting any business very very highly in the public circles, because what happens then is the moment something adverse happens in the business and you have to necessarily exit the stock, then you'll end up facing criticism from people because you were touting the stock very highly in the first place. So in the stock market, there's nothing, no such thing like, very very great, something which is eternally supreme or super good. Basically, it's all about just focusing on the facts. You just want to focus on the underlying facts of the business and just keep evaluating as you go along the way. So that's about commitment and consistency bias. The second bias which I talked about was the anchoring bias, or basically clinging on to a meaningless reference point, like for example, the cost price. You should immediately forget about the purchase price which you paid for a stock the moment you purchased it. Otherwise, it will forever affect your judgment, because that's a sunk cost, right? It has been already been incurred. All that matters for investors is the potential for future returns from the current stock price. So this initial cost price or purchase price should really means meaningless. It means nothing. Investing is all about the future. So you only want to focus on the future trajectory of the business, the return ratios, and the earnings growth, and the potential threat from new competition. So that's really what good investing is all about. And the third one is status quo bias. So this again comes from evolutionary biology. So we humans are structured to conserve our mental energy, and status quo bias basically means clinging on to a bad investment decision, sticking on to a bad relationship, or sticking on to any bad decision of the past, because you don't want to make the effort to admit that you were wrong or that facts have changed for the worse. So we just end up engaging in lazy thinking and not engaging in opportunity cost thinking. I think as investors, we should always think in terms of opportunity cost, and
Yes.
we should always evaluate our portfolio on a regular basis to see whether any of the holdings cannot even deliver fixed deposit level returns over the next 3 to 5 years. I mean, if any stock is not expected to give you even fixed FD returns over the next 3 5 years, then it's time to replace that with a much better alternative. And there is no dearth of opportunities in the stock market. I mean, the stock market is a stream of never-ending opportunities.
Oh, absolutely. In fact, I like your statement, Gautam, that
Yeah,
there is
so
good market going on at every point in the market itself. Now, since you've said, before we move to the next question on your book itself, how often should you review a portfolio? I think this is one question that also is on the mind of a lot of retail investors.
So just diligently monitor all your portfolio holdings on a daily basis. You can set up Google News alerts. You can set up alerts on tools like Screener.in and other tools. So just monitor, basically, as long as the trajectory of the business is on track, and if as long as there is no adverse development, especially with regards to corporate governance, just stay put and just just participate in the wealth creation journey alongside the promoters. I think that's the best piece of advice I can give to all your viewers. Just focus on the underlying facts and be a realist and be a rational optimist. I think that's the best way to approach investing.
Absolutely. One more term that I like, rational optimist. So one more term that you've used in your book, Gautam, is culture as a moat. What does that really mean, and what does that entail?
So we often discuss the traditional sources of competitive advantage like pricing power, network effects, high switching cost, distribution advantage, but a much underappreciated and difficult to replicate competitive advantage is that of culture. And culture is best exemplified by organizations such as Berkshire Hathaway, Nebraska Furniture Mart, Geico, Costco, Constellation Software, and others. And to illustrate the significance of culture, consider this. Between 1957 to 1969, when Warren Buffett was running the Buffett Partnership Hedge Fund, he did not mention the word culture even once in his letters to investors. But from 1970 to 2020, when he
Yeah.
was running Berkshire Hathaway, he has mentioned the word culture more than 35 times in his shareholder letters. As investors, we are looking for companies that are fanatically obsessed with the well being of their customers and empathize with them more than their competitors do. And for long term investors, culture matters because it empowers the company's employees to perform their daily tasks slightly better than their competitors do. And over time, these tiny advantages compound into much larger advantages that persist far longer than conventional wisdom suggests. The answer to the question, what will widen the company's moat, should always drive the management strategy and the corporate culture. For Facebook, it is all about driving user engagement on its various social media platforms like Facebook, WhatsApp, Instagram. For Amazon, it's all about improving the customer experience in terms of flexibility, speed, options, wider selection. For Costco and Nebraska Furniture Mart and Geico, it's all about sharing economies of scale with their customers in the form of lower prices. And when we invest in companies that are widening the moat, over time, these companies invariably turn out to be much more highly valuable than the results from our initial valuation work. And this is why culture matters to long term investors.
Absolutely. Point taken. And one last point that you've carried as a practice from your book and as a philosophy at Stellar Wealth as well, Gautam, has been two strong ideations that you carry. One is obviously identifying strong businesses, compounding businesses based on variant perception and long structural trends. I know you've elaborated a tad bit on both of them, but if you can just elaborate on these two investment themes once again for our users.
I've already talked about the long term structural trends, about having favorable industry structure, experiencing some form of industry tailwind, and having value migration and having consistency and predictability of cash flows. Multiple structural growth plays like CDMOs, CRAMs, fintech, music streaming, e-commerce, digital transformation, cloud computing, animal healthcare. So that's basically when you get a large opportunity size juxtaposed with a high ROIC, you get compounding machines. So that is basically what long-term structural trends is about. Variant perception is where you get ROC expansion coupled with earnings growth and valuation rating, and you get alpha generation. So variant perception comes from having a differentiated view on the short to medium term trajectory of a business. And there are multiple triggers for variant perception, namely product mix change. So if a company goes for a product mix change, having higher margins, that can lead to ROC expansion. So that's one. Second is companies engaging in capex. So once the pre-production costs are recovered and then operating leverage starts playing out, you get very exponential earnings growth. So that's another source for variant perception. Capex followed by operating leverage. Also, in such situations, once the deleveraging process starts, so once the debt starts getting paid off, interest costs go down, the net profit goes up, market cap goes up. So that's another trigger, deleveraging. Another source for variant perception is that of an industry cycle shift. So I talked about how the residential real estate in India turned around from middle of 2020, and that has led to many multi-baggers from the real estate and the building materials basket. So that's another good source for variant perception. Another source is that of government regulatory change or a thrust by the government. So since early 2020, we have seen the government of India's thrust on ethanol blending, and you have had multiple multi-baggers coming out of many distillery companies and companies which are setting up their distillery operations. Another source for variant perception is improvement in asset turns. So this information you can easily get from the conference call. You can ask the management on what the expected fixed asset turnover will be on the new capacity. And between margin expansion and improvement in asset turns, which lead to ROC expansion, I prefer the latter, the improvement in asset turns, because high margins tend to attract competition. Some more sources for variant perception comes from corporate actions like promoter and management change. So here I'll give a good example. So in August 2020, the stock of CG Power was trading at sub 10 rupees. And in 2019, the company had been hit with a 3,000 crore rupee fraud. And the company was mired in corporate governance issues. In August 2020, entered the Murugappa Group from South India, a group having stellar reputation for corporate governance. What happens in the stock market is when a business with low perceived standards of corporate governance gets taken over by another group with very high standards of corporate governance, you end up getting multi-baggers. The stock of CG Power has given more than 2,000% returns since the acquisition by Murugappa Group. Another source for variant perception is that of demergers. So in demergers, you have I talked about forced selling earlier. Forced selling takes place in two situations. I talked about the sectoral demerger earlier in the form of Jubilant Ingrevia. Now I'll talk about the market cap demerger. That's also how you get the really big returns in demergers. So a few years ago, you had a micro cap named Aarti Surfactants demerged from its parent company Aarti Industries. And the institutional investors of Aarti Industries, when they were handed over this tiny micro cap Aarti Surfactants, they just wanted to dump the shares of Aarti Surfactants at whatever price they could get from the open market. So in August 2020, after Aarti Surfactants got listed, because of the forced selling by these institutional shareholders, the stock basically fell 40-50% immediately after listing, even though the underlying business was not that bad. And the promoters of the business itself themselves were buying shares from the open market. That gave you a very strong signal that there is potential in this particular business. So all that you had to do was wait for the selling pressure to get absorbed, wait for the big bulk deals block deals to happen. And once the selling pressure got over, since that day till its peak, the stock of Aarti Surfactants ended up giving you more than 700% returns. So this is an example of a market cap demerger. So this is another source of variant perception in demergers, market cap demergers and sectoral demergers. You also have reverse mergers, which is another source for variant perception. So in early 2021, you had APL Apollo announcing the merger of Apollo Tricoat with itself at a 1:1 merger ratio. And in July 2021, you had Equitas Holdings announcing the merger of Equitas Small Finance Bank with itself at a 2.26:1 merger ratio. Now, I just ask all your audience to check the stock prices of these four companies and see if there is any opportunity for merger arbitrage at play here. This is another good source for variant perception. Another very good source for variant perception is that of divestiture of any loss-making business or any non-core business. The moment a loss-making business segment is sold off, the resultant entities net profit goes up, market cap goes up. As far as the sale of a non-core business is concerned, the stock markets love focus managements. They like focus. So any business which is conglomerate tends to get what is known as a conglomerate discount.
Yes.
The moment these conglomerates sell off their non-core businesses, the valuation multiple re-rating happens and you get outsized returns. So that's another source for variant perception. And here I would like to share one very, very important principle of value creation. In the stock market, there are only two kinds of businesses, Mayuresh. One having low returns on capital employed and one having high return on capital employed. In case of companies having low returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation happens when they focus on improving their return on capital employed. And in case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation happens when they focus on increasing their top line growth. So our FlexiCap strategy is primarily based on variant perception. That is where we focus on companies where the return on capital employed is improving. And in case of our mega trend small case, where we focus on long-term structural trends, there the returns on capital employed is already very high for many companies. There we focus on companies which are focusing on increasing their top line growth. So this is basically, if you can just understand this simple principle of value creation, you'll do very, very good as an investor in the long term.
Wow, absolutely. You took a lot of time to elaborate it, Gautam. Thanks for that. Uh, Now, before we end this session, a couple of questions that the users have got. I'm not sure whether you'll be able to answer specific stock questions, Gautam. Can you, or you avoid that normally?
I would like to tackle the questions on general investing, markets, and sectoral trends if possible, and avoid stock specific questions at the moment.
So let's avoid that. When you talked about value perception, obviously, I think all these sources of information is that what you mentioned that should be taken into account. But there are certain stories, and a user Apurva has mentioned that certain stocks they start coming off significantly. Now there has to be some amount of information based on which institutions are getting off of that stock, either structurally or some change for the sector itself. So again, I think the same sources in terms of con calls, news cuttings, clippings. Is that how you'll put it, Gautam?
I think conference calls are an essential ingredient of any serious investor's toolkit. And many I think one of the good improvements in me as an investor is earlier what used to happen. If any company used to report any bad earnings and the stock used to fall down immediately after earnings during market hours, I used to sell it prematurely. But now what I've understood is you want to actually attend the conference call, listen to the management, and then take the decision whether to stick to the stock or sell it. Because many times you'll get to know that the bad quarter was just because of one-off factors, and those one-off factors are actually disclosed in the conference call. So always attend the conference calls before taking your sale decision. I think that's very, very important. Just try to understand whether it's the dent in profitability in that quarter is because of a transitory one-time factor, or is it because of any structural factor like very strong competition entering, or any or the underlying business model itself getting impaired.
So, Apurva, I think that answers your question and for all folks as well. One user has asked a question on the commodities as a space, whether it's ferrous, non-ferrous. How do you view this space, Gautam?
Well, I'm very bullish on aluminium among the metal space. I think that is where the shortage will still persist ending into late next year. So there is a very good aluminum ancillary company in India. It provides a critical input to the aluminum production process. They have completed a very large capex, and I think now that the capex is over, now the earnings and profits should start reflecting from the new capacity. So there again, it's all about bottom up rather than giving overall macro calls here.
Absolutely point taken. And one last question from a user. I think SaaS, service as a software, right? Or CPaaS. I just extend that question as well. Global companies like Sinch, Twilio have done exceedingly well. How do you view these spaces as well?
I think the business model is structurally very, very good. So software as a service is very, very good business model. And for many of these companies, OPEX is basically the CAPEX.
Yeah.
Because the marginal cost of production is basically negligible. So the logical path for these companies is to spend as much money upfront on acquiring customers, as long as the unit economics is very favorable. So you want to look at the contribution margins, and you want to look at the lifetime total value of each customer. If the lifetime total value of each customer is positive, and then only in that case these companies should focus on acquiring as many customers upfront as possible. But there are many companies for which the lifetime total value of each customer is actually negative, and they're still incurring a large amount of money on trying to acquire more customers. But so that is value destructive. The only value accretive action can happen when the unit economics and the lifetime total value of each customer is positive. So it's very important for investors to differentiate between companies with no proven path to profitability, no possible path to profitability, and the companies which are basically choosing to be unprofitable today in the promise of a much more profitable tomorrow. So there are two kinds of SaaS companies basically. One which cannot be profitable today and tomorrow, and the others which can be profitable whenever they want to be, but they're choosing to be unprofitable today because they're engaging in delayed gratification and focusing on long-term intrinsic value creation.
Absolutely. So I think there were a few questions as well, but folks, I think Gautam has already answered questions in terms of EV, auto ancillaries. He's also answered questions on the fintech part as well. For Murugesan, I think specific questions related to companies, Gautam is a little bit skeptical in not answering that. So maybe on a different forum at a different time. But anyway, I think running out of time, Gautam, I think you patiently answered all the questions posed to you. Brilliant insights given in terms of your checklists, in terms of defining investing, how do you probably value companies, important aspects of valuing businesses as well. And therefore, I think it's been a great pleasure interacting with you. You have a safe trip. I know you're going back to the US in a few days. So have a safe trip. Be safe. And when you come back to India, I think that time we'll have a face-to-face chat so that all the folks can see you and hear you physically as well. So take care. Thank you so much for sparing time and taking time out for all investors. And all you folks, I think, thank you so much for attending this. I hope it was a great value addition that you had. And all the pointers that Gautam mentioned, please take that in your learnings and your learning curve as well to become great investors going into this. Thank you so much. Thank you.
Thank you, Mayuresh. It was a pleasure.
So, Gautam, next time you're in India, I think we'll have a face-to-face kind of a interaction,
Sure.
and hopefully the COVID thing will be behind us completely. So, thanks again. Thanks.
Thank you, Mayuresh. Thank you.
Thank you.